Hello, this is James Graff with Advisors Mortgage Group with another Mortgage Minute. This is going to take more than a minute. We're going to talk about inflation, one of my favorite subjects by far. Economics. Inflation affects everything and everyone. Let's get into it. Inflation. Is the Fed rousing a slumbering giant? Is inflation a slumbering giant? It is, in fact. It's quite tame at the moment. It could rear its ugly head any moment. We could also be dealing with deflation. Let's get right into it. The Federal Reserve is expected to announce policy changes aimed at lifting inflation, according to CNBC. For many years, the Fed has had a target of 2% inflation. Now the central bank appears ready to move to a policy, quote, in which inflation above the central bank's usual target would be tolerated and even desired, unquote. That's a big shift. They're looking to raise inflation rates, I should say. So that means they're going to lower their rates in order to create economic activity which might raise inflation. They're not afraid of inflation, basically. They're afraid of deflation. I know that. I'm interjecting here. None of this is the opinion of Advisors Mortgage Group. Analysts are anticipating a policy change as soon as September, and some believe that the Fed could tolerate inflation as high as 4%, an annual rate not seen in more than 2 decades. There's a lot to be said there. That means low Fed rates. That means spurring economic activity quite seriously. So, again, that means no deflation. Moving on. So it's basically Powell's Fed is going to be more tolerant of inflation, which makes sense in these circumstances, I think. Pushing inflation past 2% would be a, quote, a whole new ball game, according to Bloomberg. Traditionally, the Fed aims to hit an inflation target by monitoring the unemployment rate and moderating growth to make sure the forecasted inflation doesn't overrun the target, which is very, very difficult to do, but they try. This is based on the theory that, quote, inflation accelerates as unemployment falls. As people get more jobs and make more money, inflation should accelerate because they should have more money to spend. I'd say it's almost a economic understood. It's not much of when they say theory, they mean like the theory that the Earth is round, or that we go around the sun. These are theories, the heliocentric theory of the Earth. Anyway, I'm sorry, I'm interjecting. Inflation accelerates as unemployment falls. Accelerates, that means it picks up speed. It gets faster and faster. To keep inflation in check, the central bank raises interest rates and tightens the money supply. However, Fed worries about inflation, quote, Fed worries about inflation, quote, induced it to raise rates too early in the cycle and continue to boost them into late 2018, even as faltering markets signaled the hikes had gone too far, unquote, which, interesting enough, President Trump got very angry about. Perhaps he was right? Okay, now Fed Chairman Jerome Powell and economic policymakers appear willing to speed the recovery by keeping interest rates near zero, until inflation hits the target or even goes beyond it, if that's needed to create jobs. Now, the interesting thing here is that this is my field of interest. It's like my sport in a way. Jerome Powell is the very first chair of the board chair of the Federal Reserve Board that does not have an economics degree that I'm aware of. He's a lawyer. He's an attorney who went into banking. So he's been in banking his entire life. He understands it quite well. He's extremely knowledgeable on the topic. But he did not study economics per se. He studied economics all his life by running business through banks, et cetera, et cetera. Anyway, moving on. That's my 2 cents about that. Just interesting. We're already seeing inflation at the grocery checkout, where prices have skyrocketed because of supply chain disruptions and hyperactive demand, according to CNN, which people claim leans left with their information and coverage. From February to June, meat and poultry prices have risen 11%, according to government research, with beef and veal prices spiking 20%. That's quite the that's inflation. Egg prices have also shot up 10%, and cereals and vegetables are up 4%. This has investors feeling nervous, according to Bloomberg.com. I'm not sure if they can speak for investors, but perhaps they have a pulse on that. It indeed makes me slightly nervous, but you would expect that after so much QE, so much quantitative easing by the Fed, so much buying of bonds, et cetera, et cetera, et cetera. It makes sense. It follows. Many analysts were, quote, burned badly by ominous forecasts of runaway price gains, unquote, in 2008. I was actually one of them. I thought that prices would go much faster, much farther. Like I said, we're living in an age of deflation. Technology tends to deflate the prices. So you're fighting deflation here. So they have, quote, have been hesitant. The analysts have been hesitant to repeat such calls, runaway price gains, especially as the economy sinks into a deep recession, unquote. So they don't want to say, oh, we're going to have a hyperinflation, though they would like to, but they got burned when they said that in 2008. It's a different scene. Right now it's so different from 2008. It really couldn't be more different. Was there a virus? Was there a pandemic? Was there so much equity in real estate? Different situation. But now economists, including top strategists at Goldman Sachs, are sounding an alarm. Bloomberg does not say what alarm they're sounding, but they're sounding the inflation alarm, basically. Alarm is coming. Inflation is coming. Such fears may be premature because inflation isn't the crisis we need to worry about, according to Politico. Roughly 7 million workers, quote, have likely received a dock in pay, unquote. Can we verify that? That's an interesting statement. I would say that's almost certain. Is it not? A dock in pay? People have been dock pays? I would say so. We'll find out from the more information coming in all year. In recent months, have likely been dock pay in recent months from employers trying to weather the pandemic. This is unusual because while employers cut jobs in every recession, they rarely cut pay for the workers they retain. These wage cut numbers, quote, haven't received the same attention as job losses, unquote, but reduced pay could present a major barrier to any recovery. So these are hard to capture numbers because they're again, people talk about jobs that you can talk about jobs. You can also talk about quality of jobs, the amount of money being made per person, per sector, et cetera, et cetera, et cetera. And during the pandemic, companies are actually being forced economically to retain employees. They're retaining employees so they can obtain loans from the government. The government stipulates that they must retain employees. Now, I'm not sure what it says. I do not know for a fact. We can look this up. If it says anything about retaining them at the equal salary. So you retain your employees and decrease their salaries or decrease their benefits. There are many, many ways to work this. Anyway, that's my take on inflation. We're going to move on and talk about Kodak, which is fascinating to me. This is what experts are saying about Kodak. Amateur investors get burned in Kodak frenzy. Kodak's wild stock market ride. I believe I have another video talking about how it went from under $3 to $34 or something. I'm not sure, $2 something cents to over $60. That's a 20-fold increase. I think that's Kodak, right? A warning for investors who ignore company fundamentals and focus instead on a potential pandemic connection, unquote. This is according to the Wall Street Journal. The Trump administration's announcement that it was lending $765 million to Kodak. Yes, Kodak, the used to make film for cameras, not anymore, to make drug ingredients, set off a market frenzy. This announcement, with stock prices soaring as high as $60 over the following 2 sessions. This is the stock I'm talking about, right? And more than 100,000 users on Robinhood jumping in. Robinhood is a new site that allows investors to invest very small amounts in stocks. So it has a lot of new people moving into investing with very, very small amounts of money that do move markets, perhaps. I'm not sure. More like the markets move them, I think. I don't know. Just interjecting. Professional investors got out as amateurs, quote, were running blind into the shares, unquote. One financial advisor bought 162,000 Kodak shares in May at roughly $2.50, as I was talking about before, per share, and wound up booking a 19-fold return. But Alex Olson, who opened his first brokerage account earlier this year, quote, bought 2,710 shares at an average of $35 a share, unquote, and lost $30,000 when the stock sank. Quote, I guess what I learned is trading is just gambling, unquote, said Olson. And that is not correct. It's gambling if you don't know what you're doing. You gamble with your money when you're not fully informed. This is why I'm reading this. I'm reading this to keep my clients and customers and friends and family and everyone out there informed. You must stay informed as easily and quickly and as much as thoroughly as possible. This is from all different sources, all different places I'm giving this information. Very important to stay informed, especially if you want to know anything about inflation, if you want to know anything about rates, if you want to know anything about the future, which is very, very hard to foretell. No one can foretell the future, but you can foretell what's coming basically by looking at the whole world and seeing what's happening around the world and in your area, and inflation and companies, etc. Then moving on. How much is a quarter of a Birkin? This is the same topic, actually. Birkin. If you, quote, can't afford a Birkin bag or a race horse, unquote, you can still invest in them. This is according to the New York Times. An uptick in fractional investing. This is what I was just talking about. Fractional investing. Robinhood does that. An uptick in fractional investing allows anybody to purchase shares in luxury items. Buyers can't sell those fractions until after a lockup period. Nor do they get to actually hold the products they invest in. That doesn't faze memorabilia fans such as John Cochran, who, quote, invested in shares of 76 different collectibles, including a shirt Michael Jordan wore in a basketball game, unquote. That sounds like some good investments. So you could fractionally invest in lots and lots of things that you think are going to gain value. This makes sense, and these micro markets actually help to adjust markets more accurately. I'm for and against them. I'm for them because it does help the markets come to proper prices based on people's intelligence. The more the merrier, really. The more intelligent people in a market, the more intelligent that market is. Unfortunately, this also drags unintelligent people into the market, which cannot be controlled for. So, all in all, it's a good thing. Investors in Birkin bags can get a share in a $140,000 gray Himalaya. A bag worth $140,000. That seems absurd, but this is how markets work. And if you've always wanted to feel like a prince, My Racehorse, one word, sells small shares in racehorses. That's fascinating. Okay, moving on. New perks for the pandemic age. New perks. Businesses are getting creative at trying to retain their company culture while working remotely, said, this is according to Financial Times. DoorDash says it has seen increased demand for gift cards that can be used to buy real food for a virtual work lunch. Some companies are, quote, rewarding professionals working from home with food and drink deliveries, unquote. These are the times we live in, right? I guess with one ad agency even throwing in its traditional Friday round of after-work beers. One executive there says, quote, drinks would have been the obvious cost to cut, but he wanted to lift morale, unquote. That's fun. But some employees say they have little need for office-style perks and would prefer, quote, well-being benefits like mindfulness apps, unquote, and, quote, access to online therapy. Interesting how they would prefer technology to beer, but okay. And I think with that, we'll leave it at that. And thanks for listening thus far. This has been James Graff with Advisors Mortgage Group with another Mortgage Minute, more like 15 minutes on inflation and investing. And with that, I hope that you have an absolutely fantastic day. Thanks again for listening.